Good evening, everyone. Thank you for taking out the time and joining the Market Outlook Way Ahead for 2023 webinar. My name is Nidhi Shah, and I'm the Vice President, Market Insights, Wealth Development at HSBC India. So before we welcome our guest speaker, I would like to just set the tone for today's webinar. While the post-pandemic recovery led the markets to an all-time high, the excesses created by central bankers led to inflation rising to historical levels. With the central banks rising into action to curtail inflation, the global economy started facing the ramifications of possible recession. While experts kept debating about whether the US is in a recession, India seems to have emerged as what is being referred to as an oasis amongst the dry lands. The demographic dividend and the possible thrust on the local manufacturing capabilities seem to be driving the sanguine tone. Whilst we all wish to believe what the data is showing us, an expert's view is the key in reading the fine print. Joining us today is an industry expert to understand things better. I would like to introduce Mr. Chirag Setalvad. He's head equities at HDFC Asset Management Company. Mr. Setalvad has a vast experience of over 20 years in fund management and equity research and another 4 years in investment banking. Besides HDFC AMC, he had also had brief stints at ING Bearings and New Vernon Advisory Services. I would hereby like to warmly welcome Mr. Chirag to share his view.
Thank you, Nidhi. So, if you, what I'll do is I'll start off with a brief comment on the overall market environment, and then I think Nidhi has some specific questions, and of course we'll hand over towards the end towards questions from investors. So let me start with the overall commentary and highlighting what Nidhi said as well. India is doing exceptionally well today. When you look at it from a GDP standpoint, we are still growing at 6 to 7%, and even next year is likely to be a similar number. You add another 6-7% in terms of inflation, and nominal growth in India is 13-14%. And there is no large economy which is growing at that kind of rate. In fact, most global economies are struggling to grow at all. And we are now seeing a number of economies are likely to go into a recession, which means negative growth for a number of them next year. And in that sense, from an economic standpoint, inflation in India, 6-7% is manageable. It's a level of inflation which we have dealt with in the past. And it is inflation in India is not entrenched, or there is no systematic problem in the sense that we are not facing a labor shortage like the Europe is or America is. We're not facing an energy crisis like Europe is, and so on. So I think from an economic standpoint, we are actually in good stead, and India is doing quite well. And when the economy does well, naturally companies will also do reasonably well. And I want to point out 3 or 4 broad trends that we are seeing today. And I think these are long-term trends and important to speak about. One is we are seeing a big shift from the unorganized sector to the organized sector. And this is a big trend because the unorganized sector is very large in India. It's 40, 50, 60% of various industries. The second is we are seeing real estate is showing a recovery. After many years, real estate volumes have picked up quite materially. Real estate prices across cities have been flat for almost a decade now. Maybe up 10-15%. And in that decade, obviously, salaries have increased quite considerably, which means affordability of real estate has moved up. And real estate is a large sector because when you buy a house, you obviously need to buy steel, cement, consumer durables, lighting, carpets, and so on and so forth. So it's a big driver of on-stream demand, downstream demand. And we are also seeing the banking system is in a far better situation than in the past. We are seeing NPAs have come down from 5-6% to 2-3%. We've seen growth, which used to hover around 7-8%, has now improved to 17-18%. So growth is improving, asset quality is in check, and capital adequacy is at a decade high. So the banking system is strong. The unorganized to organized shift is taking place. Real estate outlook seems to be quite positive, and the government is focused on infrastructure spending. So I think the economic climate in India is quite positive. And I'll just end with just 2 more comments. So this is the overall economic environment. I'll briefly talk a little bit about valuations. And, before I get to that, I think from a political standpoint, also India is in a unique situation. The US is getting into an election year soon enough, and there is still a lot of uncertainty on the political front in the US, in the UK as well. That's a similar situation. And when you move to China, they're facing their own set of issues. And of course, we know what is happening in Russia, etc. So in that sense, a strong political environment also leads to stability and leads to investor confidence. And I don't think that should be discounted. And now all of this is obviously leading to India having performed quite well. And stock markets in India have rallied, contrary to what we've seen elsewhere. And hence, valuations have moved up. We are trading at a premium to historical averages, whether you look at it on a relative basis or even on an absolute basis. But I think a fair amount of that is justified by the fundamentals. So we are right now, Nifty trades at about a 15% premium to its average. And I don't think 15% is something to be nervous about. I think when markets get very expensive, we should certainly be nervous. See, markets fall roughly into three categories. Markets are cheap. That's a fantastic environment to invest in, but it sometimes can be difficult because it's accompanied with bad news. And then markets are reasonable so when markets are cheap, you get fantastic returns, but the environment is hostile. When markets are reasonable, valuations are sensible, and I think that's the kind of environment we're in. So where we are close to average or 10, 15 plus minus, that's when you typically are average valuations or reasonable valuations. And then when the market is expensive, your PE multiples move up to 25, 30 and so on. And we're not in that kind of environment. So I think, are we in a cheap market? No, we're certainly not. I don't think we are in a cheap market. Are we in an expensive market? Again, I don't think we are there. I think we're somewhere in the middle. And I think if you've got a 10-year horizon or a 5 to 10-year horizon, 10, 15% excess valuation can be managed, because if you're a 10-year investor and let's say valuations are 15% above average, then you're compromising maybe 1% of return on a CAGR basis, which is not a terrible compromise. So I would still encourage investors to look constructively at markets, to invest predominantly in a systematic fashion, and to look at corrections in a constructive fashion and to buy into corrections, because over a longer period of time, I think the outlook for India is quite positive. So I'll leave that as my initial comments, and then I'll hand it to Nidhi for specific questions.
Thank you so much, Mr. Setalvad. So we have been receiving some questions. So I'll just move ahead with the first question. So regarding the recession in the US, there has been this commentary. So the markets have not been so worried about the recession. In fact, there's a school of thought which believes the recession might actually give the Fed some room for rate reduction moving ahead. Isn't this oversimplification of this entire journey from recession to normalcy and then further to growth? Thank you.
I think it is. I think it's not correct to think that just because large economies go through a recession and hence there is an ability to reduce rates, lower rates lead to higher risk appetite and higher valuations. I think that is oversimplification. So I think it depends a lot in terms of what kind of correction or slowdown or recession we are seeing. If it's a soft landing, then I think it's good news because there is excess built up in global economies. And if that slows in a calibrated fashion, then we're fine. Economies slow down in a acceptable fashion, and interest rates over a period of time will soften, and that's good news. But if economies slow down significantly and sharply, and there's a so-called hard landing, then it doesn't matter that interest rates fall even more sharply than in a calibrated environment, because it means that demand is collapsing, and that's not an environment you want to be in. Because keep in mind that almost 30-35% of Nifty earnings comes from outside of India, right? Commodities, oil and gas, and IT, and so on. So it's not that India is an insulated economy. India is relatively insulated. It's not completely insulated. So if the global economy goes through a big downturn, it will impact our demand. So that's not an outcome that we want. What we would like ideally is for the slowdown to be calibrated, for it to be measured, and for it to be what is called a soft landing. So if that happens, then it's good news. If it's a hard landing, it's not going to be good news.
Okay. Thank you so much, sir. I'll just move ahead for the next question. So there's this demographic dividend, which I mentioned in the introduction as well, and which people talk about every time they talk about India. So, if we compare to countries like the US, China, or Europe for that matter, they're experiencing negative growth in the working age population. Only in India, we see the continued positive growth. And this seems to continue. I mean, it seems probably it might go ahead for a decade or so. So does this give an immense opportunity to India to get into businesses which can be outsourced? How you see this? Do you see this advantage for India, or it seems to be like exaggerated? Thank you.
So Nidhi, it is an opportunity, right? But it's not as simple as that, right? I don't think the conclusion is so obvious that just because India's working age population is growing and the working age population elsewhere is slowing down, I don't think that's enough. So you also have to keep in mind when a working age population is growing, you need to provide social infrastructure, you need to provide education, you need to provide a lot of other things. And if a higher working age population, if it's not adequately employed, results in higher unemployment, results in dissatisfaction, results in social unrest, and so on and so forth. So it's not as simple as that. It's not that the working population increases and that's the demographic dividend and we'll do fine. So I think the demographic dividend is an opportunity. The question is, do we use that opportunity sensibly? Do we create the social infrastructure around it? And there are some pluses and minuses, which at least today that we see there is efforts being made, but yeah, it's not enough, right? So you need enough of physical infrastructure, you need enough of social infrastructure. I think there's a lot of focus on physical infrastructure. There is not enough of focus on social infrastructure. So I don't think what can be a demographic dividend can turn to be a demographic demon very quickly if you don't harness it properly. So it's like anything else. If you race ahead too fast, it does lead to does have some negative consequences as well. So I think it's an opportunity. It's better to be in this position than to be in a position where the working age population is slowing down. So we are in an advantageous position. It's up to us now as a political system and as an economy to harness it. And if we don't harness it, then the same advantage can turn out to be a disadvantage. And at the end of the day, while all of this is important, economy and demographics is all important, I think it's also very, very, very key to keep an eye on the ground what is happening at a stock specific level, at a market valuation level. Because if you get into a market which is, if the economy may be doing fantastically, but if you get into a market which is expensive, your results tend to be compromised, and vice versa. Economy may be in terrible shape, but if you get into the market when it is, reflecting that terrible outlook and markets are very cheap, then again you have a positive outcome, which is a bit counterintuitive. So I think it depends. It's not so simple. I think there are a lot of moving parts which go into the economy, a lot of moving parts which go into equities, and some of them cancel each other out.
Thank you so much, Mr. Setalvad. So just to understand, it's basically an opportunity. So we have the raw material, but how do we use it to move to the next level? And whether we use it well with the right ingredients, is that going to decide how we actually make or break with this demographic dividend, if I'm not mistaken?
Sure, absolutely.
Okay, thank you so much. So we have another question. So at this moment, what would you really look at as an ideal allocation for a large cap or a mid cap or a small cap? Since you talked earlier about, valuations, we are somewhere in between. We are neither expensive, we are neither cheap. And would it be really advisable to maybe, if we're expecting a period of volatility, to maybe move out and considering re-entering? Because there's this markets have hit all-time high. We're still not sure about how next year moves in. So there are a lot of these questions that the investors have. So you could throw some light on that.
Sure. So I think a few questions in that one question. So let me try and answer each one. The first is in terms of allocation between large, mid, and small. And I'll just clarify your statement, what we alluded to earlier, that it's not that, markets are a little bit expensive. I think, so I think that's, the fact that we are at a P multiple, which is at a 15, 18% premium, highlights that, right? And the fact that we're at an all-time high also highlights that. But within that, there are still opportunities. There are sectors which are reasonably priced. And when you look across the spectrum of large, mid, and small, and so to me, at least at this juncture, large caps and small caps seem to offer more opportunities relative to mid caps. So when you look at Nifty, so let's look at P multiples for each of the three, which is the Nifty 50, which is large caps, the mid cap index, and the small cap index. So Nifty trades at about a 15-17% premium to its 10-year average, right? So it's a little bit expensive, but not terribly expensive. When you look at small caps, interestingly, small caps also trade at about a 16-17% premium to the 10-year average. So both large caps and small caps seem to be a little bit on the expensive side, but not terribly expensive. When you look at mid caps, the story is a little bit different because the premium there moves to 30%. That's a meaningful premium. And the way that mid caps are defined in India, it's companies from 101 to 250. It's a group of 150 companies. So I think there's a fair amount of capital chasing a select number of companies, and that's pushed up valuations. So I think large caps, mid caps, and small caps within that spectrum, I would have a preference more towards large caps and small caps as opposed to mid caps. So it creates a bit of a barbell portfolio. But I think the key in this is one is you should look at allocation on a more static basis, which is that typically within equities, now you can have you can have a 50, 60, 40, 80% allocation to equities. But within equities, typically I would recommend that one should be roughly 60, 65% large cap, and the balance should be a combination of mid and small. And that should remain more or less the same. You can add a little bit, you can make 65 to 70 or 65 to 60, and you can make that 35 into 30 or 35 into 40, but I would not swing it. So I think a lot of investors look to swing their portfolios, which is I'll be 100% in large caps when I think the large cap outlook is positive, and then I'll swing 100% to mid and small when that looks a little bit better. And I think it's very difficult to time this, right? It is very hard to figure out when large caps are going to run and when mid caps are going to run, and small caps for that matter. So I think it's important to be participating in both segments of the market, right? So I think adding a little bit 5% here or minusing 5% there is okay, but I don't think one should swing to 100, 0, 0, 100 kind of format. I think today the areas to look at more closely continue to be large caps and small caps, and I would look a little bit more I would be a little bit more careful about the mid cap category. Now, having said that, we are at a market is elevated, and hence I'm more comfortable with large caps than small caps today. So I would put the pecking order as large, then small, and then mid. Now, if the market were to correct, though, then that pecking order for me changes, because if the market were to correct, then typically large caps tend to be more resilient, mid caps next most resilient, and small caps the least. Of course, every market correction is different, so it doesn't have to follow that approach. But if it did, and small caps, if the market were to correct, and if small caps were to correct more, then all of a sudden that category would look to be the most interesting. And then I would switch it over to being small cap, mid cap, small cap, large cap, mid cap. So I think one is steady state investing. So I think today we are suggesting to investors to follow more of an SIP format than a lump sum format, and to look more 65, 70% large cap and the balance in small cap. As and when, or if and when the market were to correct, then one can have a more constructive approach to small caps, and then one can do a little bit more of a lump sum format, both in large cap, but you can also add small caps to that list. But having said that, I think it's also, there is, some investors when markets are elevated, they are reticent to invest in small caps, and they think that mid caps offer more safety and so on. And I think when you do invest in mid caps today, it's important to look at portfolios which are well diversified. It's important to look at portfolios which are still which are still a little bit value centric. And I think that's where, that's something that we do reasonably well. So I look after the mid cap fund at HDFC, and we have amongst the lowest P multiples across peers, and I think that's a good metric to have. So our portfolio P is 25-30% lower than industry average. We still have decent growth, and we still have decent ROEs. So I think it's important. It's not that one should not invest in mid caps at all, but one should be a little bit more careful. One should look at more diversified products, and one which are a little bit more conservative in their approach today.
Okay. Thank you so much for that. I guess it was a pretty in-depth and insight how you should really look, because the general idea is, okay, you decide large cap, mid cap, small cap, but this really kind of gave a very clear insight.
But again, this just to interrupt, the key in this is not to do the swings, right? And not to do the 100-0. Because the market, it's interesting. The market is always rotating, and what does that mean? The market rotates between all types of formats. The market rotates from growth to value. The market rotates from sector to sector. So sometimes it's IT and pharma, sometimes it is another sector. The market rotates between market capitalization. So sometimes it's large cap, sometimes it's mid cap, sometimes it's large, and so, by being present only in one segment of the market, right? So if you're only in growth stocks and the market pivots to value, then you get left behind. If you're only in large caps and the market pivots to mid caps, you're left behind and vice versa. So I think it's important to be present. If you're a long-term investor, if you're not somebody who's trying to uh, time the market, and timing the market is extremely difficult to get right. So if you're not trying to time the market and you're here from a wealth creation standpoint and you're really trying to build assets over 10-year, 15-year period, it's not that you want to be only present in one segment. So I think diversification is not only investing across 5 mutual fund houses. So just by putting money in HDFC and ICICI and DSP and so on and so forth, that's not diversification. Diversification is when you diversify across styles, growth managers, value managers, mid cap, small cap, large cap, right? I think that's more genuine diversification. So I think when you look at portfolios, if you invest in the same type of portfolios across 5 fund houses, that's not diversification. So I think that's important to look at.
Thanks again. I mean, that's the reason we have experts answering our questions today. Thank you so much for that. So I'll move on to the next question. So earlier we were talking about what's the demographical advantage that we talked about, which is a very obvious, I would say, opportunity for India. But within this entire positivity, and I would say, everybody going gung-ho about India, I guess somewhere are we missing the fine prints? Is there some headwind which is specifically headed towards India? Are there any specific, I would say, things which could hamper this entire growth, which you think is something missed in this entire positive situation?
Yeah, I think there are always headwinds, right? So I think the market is interesting because in good times there is always good news and bad news out there. And in a bull market, you ignore the bad news and you focus on the good news. And in a bear market, you focus on the bad news and you ignore the good news. And there is no market where there is only good news, and there is no market in which there is only bad news, right? So we have a number of factors which are positive, and we've spoken about that, about the real estate sector, about unorganized to organized, and about overall growth being decent, inflation being manageable, and politics being favorable, and so on. But there are some concerns out there as well, right? So those would include, we are seeing a slowdown in rural areas, and that does 65% of India is employed in the agrarian sector. So that is something that we need to be watchful for. So that slowdown does impact different companies to different degrees, and I think that is certainly something to look out for. I think the fact that global economies slow down is a big negative, right? If they slow down materially, India will not escape unscathed, right? Because we are meaningfully exposed. 35%, as I mentioned, of earnings come from outside or from sectors which are highly dependent on global demand and global outlook in commodity prices and so on. So I think the big risks out there are obviously, needless to say, what is happening from a global growth perspective, what is happening in rural India, and even things like China, right? If China goes through a material slowdown, it's an extremely large economy and a large consumer of commodities, and it has some benefits. It does result in China plus one and so on, but it's not that it doesn't have negative implications. And you don't want a large economy like that going through significant stress. So I think these issues are out there and need to be watched out for. And commodity prices, I think, is the other. We've seen commodity prices run up very, very sharply and then now correct quite meaningfully. But there has been significant underinvestment in commodities in the last 5-10 years because of ESG and because of a number of other concerns. So there has been underinvestment in commodities. So if demand comes back a little bit and things settle down, and if the investments in commodities are not sufficient, it can put some upward pressure on commodities as well. So I think we have to be watchful for that.
Okay. Yeah. Thank you so much for that. So we'll move ahead to the next question. So we are in the age of consumer tech, fintech, and these consumer acquisition driven companies. So if I have to really say, this is new age digital companies, they still have not established like the actual route to profitability. So do you think we should be wary of this kind of a norm, or this is a new norm which has arrived, wherein the customer experience, or we may say the customer acquisition, seems to be more important than profitability? And is it something that's going to be there currently, or this is a new way of valuing these new companies, because they seem to be here for good, at least for some time, the fintech or the consumer tech companies? So what's your view on that?
So there is obviously a lot of disruption, a lot of new age businesses which are, which are emerging, and some of them have obviously come to the equity markets, listed markets. But it's all at a price, right? And these businesses are not easy to understand because the profitability is in the near term is difficult to understand, and there is a lot of promise of profitability, 5 years from now, 10 years from now, and so on. So if that doesn't pan out, then you're obviously in trouble. But these some of these businesses have corrected very sharply, right? 30, 40, 50, 60%. And it makes it more interesting because the your room to be wrong in your judgment on earnings and forecasts is a little, you have more maneuverability, right? When valuations are expensive, you can't go wrong at all because there is very little room for that. And now I think there is more room for that. So I think it's more interesting to evaluate these businesses today at this juncture, at these valuations. It's more interesting to look at. That doesn't mean that one should buy or should not buy. It's very, very company specific, right? So, but I think we are at this level in some of the, without getting into specific names, we do find that we certainly are a lot more keen to figure out these businesses, and we're a lot more open to them than we were when valuations were expensive, much more expensive. But it's still difficult, right? Because we are not attuned normally to looking at these type of loss-making companies where profitability is far away in the future. Some of these businesses don't make money at a PAT level or an EBITDA level, and so on. So it's I'm quite old-fashioned in my thinking, and I think a big part of what we do is at HDFC, and I think this is true for a lot of other fund houses as well, you want to stick to your circle of competence, right? And I think this phrase has been beaten to death, unfortunately. But risk is investing in what you understand. And if you don't understand something, I think it's best to stay away. So we'll really try hard and our best, and we have fantastic analysts here at HDFC who try to understand new age businesses. And we try to build in a margin of safety, because you need a greater margin of safety sometimes in these companies, because the error to go wrong is even greater. So I think we'll try and understand them. If we can't wrap our heads around the business model and we can't get confidence and profitability, it's okay. We'd rather stay away and miss out on a big opportunity as opposed to getting in half-baked and getting it wrong. But having said that, in summation, at these prices, it's certainly much more interesting. But the jury is still out there in terms of whether all of these are worth owning or some of these are worth owning. But it's certainly a lot more interesting.
Sure, thank you. So just to kind of understand, and I kind of read about this, they say there's a known unknown and there's an unknown unknown. So if it's a known unknown wherein we understand it to a certain extent and we have a calculated risk, we really want to go for it. But if it's a completely unknown unknown, even at whatever valuation or whatever growth it's coming out, we rather look the other way around.
Yeah.
Okay. Yeah. Thank you. So we'll move ahead to the next question. There have been a streams of questions. So this one is actually very topical about the recent credit offtake, which has been quite robust, and the banking sector also seems to be poised for better times. There has been talk about how in the past we had a lot of NPAs, and the banks, both PSU and private, were reeling under that. But it seems that we have those times slightly behind us, the reforms and everything taking place. So even if we have to look at growth for the banking sector, moving ahead, how do you think the PSU lenders stack up against the private one, and how important is this stable banking system for the next leg of growth for India?
Having a stable banking system is absolutely imperative, right? Banks provide the liquidity which pushes the economy forward. So when a banking system is dysfunctional or suboptimal, then of course it has a huge impact on the overall economy. And I think the banking system is in a far, far better position today than it has been for many years on all parameters, interestingly. So if you look at firstly on asset quality, if you go back to where we were in 1920, from being at 5-6% NPAs, we are now down to 2.5%. So it's been a sharp improvement on the NPA front on asset quality. At the same time, capital adequacy, which used to be sort of 10, 11, 12%, has moved up to 13, 14%. So capital adequacy is at a decade high. So banks are sitting on significant capital. And lastly, growth, which used to stagnate around 7, 8%, has now improved materially to 18, 19%. So we're seeing a good improvement. And that's driven by retail demand, that's driven by corporate offtake and all of that. So I think the banking system is in a far better situation. So I think that's the good news. And in that environment, I think everybody will participate, right? So when the pie enlarges, everybody gets a piece of it, right? Private sector banks, public sector banks, everybody will benefit. And you can see that. You can see that in quarterly numbers of both private sector entities as well as public sector entities. But I think the public sector story sometimes can be more cyclical in nature. And I think the private sector story tends to be more secular in nature, which means that over a period of time, you have to have technology, you have to be customer centric, you have to have strong retail presence and so on. And so I think that's a little bit of a differentiation I would have between the two. But I think today's financials do look quite interesting. But I think, again, this is a bit of oversimplification because while this is the good news, what is unknown is how the cost of deposits will move, right? So we are seeing a sharp movement upwards in credit offtake, but our deposits keeping up in terms of growth. And if they don't, then there's going to be a fight for deposits. And if there is a fight for deposits, then all of a sudden you'll see your cost of funding goes up and your profitability starts getting squeezed. So just because NPAs and growth and all of that, those stars are getting aligned, but you also need deposits to align themselves. And right now, deposits are lagging behind credit offtake. And if that continues, then all of a sudden, that would put pressure on the deposit franchise. And hence, we are focused much more on strong liability franchises. What that means is banks which have strong CASA, which have granular deposits. I think that is, a key strength as opposed to the asset side of the balance sheet, which is about lending. So it's about how you fund it. I think that's very important. So you need low cost of funding and strong distribution. And a lot of public sector banks are there. And I think this is, unfortunately, we paint companies with a PSU versus non-PSU brush. But, it's not so simple. There are really high quality private sector banks, but there are also poor quality private sector banks. And we all know which one is which. At the same time, there are some high quality public sector banks and some not so good public sector banks. So to say that, all public sector banks are, of a certain type is not fair, or private sector banks for that matter. It's not fair to say that. And if you extend that argument to a broader level, public sector entities across industries are very, very different. You can find fantastic public sector defense companies. You can find some not so good public sector companies in other areas. So it's not that, public sector is not a bad word. It depends. You have to focus on the industry. You have to focus on the company. You have to focus on the management. So this is a very granular business. This is a very, this is not, a big picture is important, but it's at the end of the day, a lot of it is about getting specific to the sector, getting specific to the company. And in which case, when you get specific, you'll realize there's some great opportunities on both sides, on public as well as private, whether it's in banks or outside of banks. So I think you have to look beyond ownership. Ownership is one factor, but when you evaluate a business, there are dozens of factors which you have to look at, and those dozens of factors are also changing over a period of time. And that's what makes this business interesting and challenging.
Yes, thank you again so much for spelling it out so clearly for all of us. So we'll move to the next question. So in the introduction, you had mentioned about, the growth in real estate sector. And now with hybrid working coming in wake of COVID, and it seems it might really stay for some time, or companies would like to explore that. So do you think that would really impact commercial real estate, or it's not going to be a major thing? Or how do you stack up the housing and the commercial demand in the real estate sector? If you could throw some light on that.
Sure. Real estate at the end of the day is very, very geographic specific, right? So that's, I think, one comment. You can't just look at it, each city is different, within each city areas are different and so on. But I think residential in particular, to me, looks quite interesting because Like I said, we've had 7-8 years of flat housing prices, and I suspect in 7-8 years salaries would have doubled. You assume that real estate prices have moved up by 15-20%. So there's a 20% increase in housing prices and 100% increase in salaries, which means affordability is at a multi-year high. And people are keen to move into modern amenities and modern buildings and so on. So I think residential demand certainly is already seeing a big uptick in terms of new launches, uptick in volumes, and so on. And we can see that in the results of real estate companies. We can see that in the commentary which is being made. And most importantly, RERA provides a fantastic framework, right? Because earlier there was a lot of discomfort buying a building under construction because the responsibility and on the onus on the builder was low. And now with RERA, the responsibility and onus on the builder is quite high. If you don't deliver in time, you got to pay civil penalties, and if you still don't deliver on time, then you will face criminal penalties. And that means that investors will have a lot more confidence. So a combination of high confidence and higher affordability, really pushes things forward much faster. So certainly in residential, I think the outlook is quite optimistic. Now, that doesn't mean necessarily that real estate companies are great opportunities, because then you have to get again stock specific, right? What are individual companies doing? Which areas are they investing in? What are their valuations? What is the management, and so on and so forth, right? So it's not a simple correlation. Having said that, on the commercial side, yes, work from home is important, but I think we see this across industries that whether it's IT or financial services, that people want employees to get back to work, right? And it's not only Infosys and Tesla, but it's companies across the board. You need to create culture, and it's hard to create culture when people are looking at icons on a screen. You need to interact physically. So I think people will come back to the workforce, and that's why that push is there. And I hope there is a hybrid model, because we want that hybrid is good for a variety of people. It's good for women in the workforce. It's good for, it's good to have a more balanced existence. But I don't think, I think we lost that balance pre-COVID, and then maybe we lost it again during COVID. And now it's coming back to maybe a happier equilibrium. But I don't think that means that commercial is dead at all. This is a lot about supply and demand, right? So I think it's not only that demand has come down a little bit. It's also if demand comes down, the supply comes down faster, then you're okay. So is commercial? I think I would prefer residential to commercial in general, but you have to again get very, very specific once you say that broad comment.
Yes. Thank you so much. Thank you for the candid additions in between. So we'll move on to the next question. I'm sorry, there have been streams of questions. I have to just kind of go ahead. Yeah. So you mentioned one interesting thing about, how when China is really kind of not in the best shape, and rather than just looking at it as China plus one. So there is another not exactly related to the China plus one, but it is talking about the China lockdown, which is continuing, which is in and out of lockdown. There are protests happening, and obviously it has been one of the major, suppliers of commodity. And how would you really kind of read this entire situation wherein China is facing uncertain times? Would that really impact, commodity supplies, and could really snowball into a bigger situation, as well as there is a lot of liquidity in terms of it is basically even adding to inflation to a certain extent. So how do you read this entire situation?
It's interesting. We sit in India and we know so little about China, and yet we prognosticate in terms of so much about our knowledge about China, and it's limited, right? So let us, I think, keep that at the forefront, right? That none of us are great experts on China. We are just about experts on India, and even that is arguable. But I think the story is quite simple, right? You don't want any large economy to go through the grind, right? It's just not good for the system, right? So if China slows down materially, that's not good news. And if China reflates very fast, that's also not good news. So you don't want outliers. But having said that, I don't think, at least my view is, and this is more just a general perspective than on China, is you can't, we've all economies, all countries have realized you can't suppress COVID, right? You have, it's going to get out there, right? And we had small countries like Singapore, which realized it. We had large countries like India with poor health infrastructure, which also had to deal with it. And we went through an extremely torrid time. at some point. So I don't think you can keep repressing this. I think at some point of time you have to open up the economy because the public opinion will require it. And when that happens, you will have to go through that pain, right? Unlikely that you won't, because you have a population which is reasonably aged and you have a population which is not fully inoculated and so on. So when you don't have enough vaccination, it's going to have some implications. So, they will, like everybody else, we've gone past that stage, fortunately, and hopefully won't get back there in the future. But China has not gone through that. So, it would seem unusual that they open up the economy and nothing happens, right? We opened up and it was tough, and everybody else opened up and it was tough for everybody. So in which case China would possibly go through a slowdown. And that has various implications. It has, because a lot of people are looking to China to open up as a means to support growth. But does that happen? It's not so clear. It will eventually down the road lead to supporting growth, but in the shorter period of time, it may actually result in in negativity, because right now people are sitting at home and not consuming. And but if you open it up and people fall sick, that creates a different set of issues. So I think it's difficult to figure this out. But I would think that the China real estate story is also of concern, right? Because that's a very large contributor to the economy. It's a very large contributor to state finances. Almost 35% of state financing comes related to real estate, and that segment is going through a large correction. So I think China is going to be a tough story for some time. I don't think it's going to get out of the woods so quickly. So that's why India really stands out. Which economy is growing well with a strong political system, right? Which is meaningful in size. We can't talk about sort of itty-bitty small economies. So India, that's why it stands out. So I'm not clear about the China story, but there are those, I think, little concerned in terms of how the opening up will, in the short term, impact things.
Okay. Thank you so much. I guess I'll take one last question just to do justice to all to the questions that we have received. So a lot of we have read about the millennial investors in India since some time. The SIP book shows the inflows in the mutual fund shows the support when the FIIs pulled out in the recent past. The retail investors or the DII, supported by this new millennial investor kind of didn't let the Indian indices fall, or to the extent that global markets were following. So do we think this as the emergence of, the new support for Indian indices, which we have been waiting since some time, because every time that was a situation where the FIIs pulled out and the markets reeled because of that massive outflow. And then again, when they pulled in, the market cheers. So do you think this phenomena is going to spell better times for the Indian indices moving ahead?
Again, I'm a big believer that the more things change, the more they remain the same, right? Keep in mind, FIs still own 20% of market cap. That's 40% of free float. That's not a small number, right? So it's not that the domestic investors have taken over. Mutual fund DI ownership is probably 8-9%, and it's almost double of that for FIs. So these are large shareholders, right? So yes, the domestic shareholder tends to be a little bit more resilient, and SIP inflows tend to be more resilient. So it does give some cushion. But at the end of the day, the dog wags the tail. Tail doesn't wag the dog, which means that liquidity only can do so much. At the end of the day, economy has to do well, companies have to do well, and then if you have liquidity, fantastic, right? But you can have plenty of liquidity, but it won't get you anywhere if the economy and companies don't get the job done. So I think we have to move away from this focus on liquidity. We have to focus much more on economy, which is difficult to figure out. So in which case, let us focus a lot more on companies, right? Because that's a little bit easier. So hence, I always say that look at companies, see how their performance is, see how they're getting valued, and that framework, then move forward. I think in all of this, these questions are genuinely very interesting. But I think sometimes we miss the big picture, right? And the big picture is get asset allocation right. Don't think about the short term. Get how much you have in equities and how much you have in low risk assets is what is going to drive your portfolio. Number one. Number two, think for the long term. Long term is not 3 and 5 years. Long term is 10, 15, 20 years, right? And in insurance, you invest for 15 years and 20 years, but somehow in mutual funds, 5 years seems like a long period of time, and 10 years, oh, that's very long, and 15 years, oh, that's ridiculously long. But you don't think 15 years is ridiculously long in insurance. So I think you have to have a really extended time frame. Successful investors have had the same mantra for decades and eons, which is continue to invest systematically, invest for the long term, invest more aggressively when markets collapse, right? And have an asset allocation which is appropriate, right? And try and stretch it to the maximum, considering your lifestyle, considering your life stage, considering your liquidity requirements, so on and so on. But I think those are much, much more important, and to have adequate diversification. So I think we have to look at these things as opposed to look at short-term returns and what is happening in China and US and so on. The interesting part is today the discussion is about a certain set of concerns. The one thing which is certain is 5 years from now or 3 years from now, the set of concerns will change dramatically, right? The set of concerns 3 years ago were totally different. And the set of concerns 3 years prior to that was totally different. So what leads us to believe that we're going to face the same set of concerns 5 years from now or 3 years from now? So focus on the basics, keep investing regularly. And if the markets correct meaningfully, get more aggressive. And have a strong asset allocation framework in place. And I think that is really what works over the longer term. So I think we very often we get up, we miss the woods for the trees, right? So or vice versa. So I think getting our basics in place is extremely, extremely important.
I guess I couldn't have thanked you enough for that explanation, Mr. Setalvad. So I guess it's really answered the question, and I'm sure everybody's gained a lot, where really exactly to what exactly we need to look for. It's the basics and the fundamentals, and it's the disciplined investment that we all have been talking about, but I guess we sometimes miss the picture. So I would actually like to really thank you for taking our time for today's session and everybody who's joined in for session. And I'm sure it was a very enriching and value creating. And I guess, as we said, hearing from the experts, we did get a lot of expert views and a lot of expert insights today. So thank you very much for that. And with this, we'll close today's session. So good evening and good weekend to everyone. And thank you so much, Mr. Chirag, again. Thank you.
Thank you, Nidhi, and thank you everybody for joining in. We really appreciate it.